AI is forcing me to change how I manage my money. You see, I've earned millions from investing over the past 20 years, and the majority of that wealth has come from one straightforward approach: a low-cost S&P 500 index fund. This is what's known as passive investing, as your money is automatically divided across the top 500 companies in the USA. So instead of needing to actively choose winning stocks, you simply buy a tiny slice of all of them. The logic is that even if some stocks collapse, owning many of them cushions you, and you still gain as the overall market expands. I'm not going to pretend otherwise. Over the years, this has turned out to be an outstanding strategy. As I mentioned, I've made millions by doing exactly this. However, after creating my last video about a potential AI bubble, I sat down, reviewed my portfolio, and implemented a few adjustments. So in this video, I'm going to reveal the 5 moves I've made because of AI. Believe it or not, for every $1 you put into the S&P 500, 40 cents of it ends up in just 10 companies. Those companies are NVIDIA, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and finally, JP Morgan. At the time of recording this video, these companies account for an enormous 40% of the entire index fund. What's even more alarming is that NVIDIA alone will receive between 7 and 8 cents of every $1 you invest into the S&P 500. This is because the index fund is what's known as market cap weighted, which basically means the more valuable a company becomes, the larger slice of the fund it occupies. So what is actually causing these companies to grow more and more valuable? Well, if we put Berkshire Hathaway and JP Morgan to one side for a moment, because they don't really follow the same pattern, something interesting starts to emerge. What we're left with is a set of companies that share one very specific characteristic. They're all spending heavily on the same thing: AI. You might be thinking, that sounds great. AI is the future, so this all adds up. However, not so quickly. For all these AI-focused companies to justify their current valuations, they would need to generate around $2 trillion in revenue. To put that into context, that's more than NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta combined in 2024. This illustrates that the companies at the top of the S&P 500 are not being priced purely on what they own today, but on what investors believe they will earn in the years ahead. Now, this isn't a huge problem on its own, as it's very normal for companies to be valued based on their future potential. However, it becomes quite troubling when it's all tied to a single type of technology. These companies are effectively all making the same wager that AI is the future, and they're funding it with an enormous amount of debt. A strong example of this is Sam Altman stating he's prepared to commit $1.4 trillion in spending for AI infrastructure, while his company, OpenAI, is currently only bringing in $13 to $20 billion in annual revenue. A lot of this borrowing is also quite hidden. As I talked about in my previous video, these companies are inflating their valuations by circulating money between one another. It's an entire tangled situation. To cut a long story short, it's one massive feedback loop that continually feeds back into itself. Larger companies draw in more passive investment, which drives their share prices higher, giving them a bigger slice of the S&P 500, and therefore even more capital to grow from passive index fund investors just like us. This is having a knock-on impact of making the US economy appear strong. However, research from Deutsche Bank actually suggests that if it weren't for AI-related spending right now, then we would already be in a recession. So what if instead of favoring the largest companies, we could spread our money evenly across every company in the S&P 500? Well, we actually can by using something called an equal-weighted S&P 500 index fund, and at first glance, it looks like the ideal fix. Instead of having 40% concentrated in the top 10 stocks, it's closer to 2%, as every company is treated the same. By investing in something like this, there's no doubt that you are less exposed to the possible AI bubble that's currently inflating. However, it's not a flawless answer, because as we try to limit the cash flowing into the biggest companies, it may actually create a much larger issue, as it follows what's known as a negative momentum strategy, which sounds technical, but it's really simple. All it means is that when a company in the S&P 500 starts to surge, think of Tesla during its huge rally, the fund automatically sells a portion as it climbs and uses that cash to purchase companies that haven't risen. So you're essentially offloading the winners and picking up the laggards purely to keep everything level. By contrast, a standard S&P 500 index fund that's market cap weighted doesn't need to trade nearly as frequently. When a company builds momentum, it's simply allowed to occupy a larger share of the index. Rather than cutting back the winners, the fund gradually scales down exposure to smaller firms to make room for the bigger ones. But why does this matter? Well, the more a fund trades, the higher the costs become. As a result, it's something that often gets ignored and can slowly erode your returns. That's why, even though I'm directing less money into the S&P 500, I'm still keeping most of my stock market holdings in the standard market cap weighted version. So now that I've freed up some of my capital from the S&P 500, the real question is, where is it going? Well, that brings me to, I want you to picture for a moment that the biggest stock market gains over the next 20 years don't actually come from the USA. I know that might sound insane, because for the last 14 years, the American markets have completely dominated. However, this chart reveals which countries accounted for the largest share of the global stock market at different points in history. And guess what? It hasn't always been the USA. I know this looks a little confusing, but it's basically showing the global stock market like a cake with multiple layers. Each color stands for a different country, and the thickness of each layer shows the percentage of the world stock market that country represents at that moment. The cake itself doesn't change. It's always the worldwide market. What shifts is which layers get thicker and which layers get thinner. Let's go back to 1900. The United Kingdom was the global powerhouse. As you can see, they owned a big, juicy 24% slice of the global stock market cake. London was the financial hub of the world. British companies controlled global trade, and the empire stretched over vast parts of the planet. If you were investing back then, it would have felt completely obvious that the UK would stay the dominant economic power for the next 100 years. Putting your money anywhere else would have seemed absurd, and yet that's not how history unfolded. I remember seeing something very similar happen later with Japan. I traveled to Japan a lot in the late 1980s and early 90s, and at that time, Japanese companies were doing incredibly well, especially in sectors like cars, electronics, and technology. Meanwhile, the US economy was under pressure, inflation was high, growth was slowing, and many people were convinced that Japan was the future. So if you were investing during that period, would you really have bet against Japan and doubled down on the US? Probably not. However, America roared back in a big way. This highlights that the only thing that has ever been guaranteed in markets is uncertainty. Leadership rotates, economic power shifts, and no nation stays on top forever, which is precisely why I don't want my portfolio to depend entirely on a single market, even one as strong as the US. Because when you only invest in the S&P 500, you completely miss out on companies like TSMC, Samsung, Toyota, Tencent, AstraZeneca, and HSBC. These are global businesses operating at massive scale, driving genuine growth, yet they're excluded solely because of where they're headquartered. So how am I actually investing on a global basis? Well, this is Trading 212. It's the brokerage I personally use. And if you head to the search bar and type in VWRP, you'll see this global stock market fund that gives you instant access to almost the entire world economy. This single fund holds around 3,700 to 3,800 companies across more than 45 developed and emerging countries, including the US, the UK, Europe, Japan, and rapidly growing markets like China and India. And yes, I know if you look closely at what these funds actually own, you'll notice they're still heavily tilted toward US stocks. The difference lies in what happens over time. A global fund automatically rebalances. If the US loses dominance and China or another country starts to outperform, the fund adjusts. If the US continues to lead, it adjusts for that as well. It also comes with a very low expense ratio of 0.19%. That means for every $1,000 you invest, you're paying about $1.90 per year in fees, which is very inexpensive. If you're based in the USA, then I would suggest looking into Fidelity's international fund with the ticker FSPSX. If all of this feels a little overwhelming, Trading 212 actually makes things very straightforward with their model pies. These are ready-made, globally diversified portfolios created by professional asset managers, and you can simply choose a risk level that feels right for you. If you're new to investing, then you can start with as little as £1, claim your free fractional shares, and get familiar with the app before fully committing. You can also invite your friends, and once they fund their accounts, you'll both receive free fractional shares. The best piece of advice I've ever received about building lasting wealth is that you don't become rich by moving with the crowd. You become rich by being early. I've applied this mindset throughout my entire life. So, in addition to protecting myself from a possible AI bubble, I also believe it's crucial to look for ways to profit from this new technology. So let me walk you through where I currently see the biggest openings. The market naturally splits into 4 clear zones, each filled with different types of companies. Well, that's how I like to think about it anyway. Let's begin with this one. I call it the crowded zone. Companies in this area have huge market caps and rich valuations. Think of the leading names in the S&P 500, like NVIDIA, Tesla, and Meta. It's crowded because everyone is already piling in here, including passive investors. Beneath that, we have the defensive zone. This includes businesses like McDonald's, Walmart, and Coca-Cola. These are companies that people depend on, no matter what's happening in the economy. These are exactly the kinds of stocks value investors, such as Warren Buffett, gravitate toward. Their valuations aren't exactly cheap, but they offer solid value because their earnings are reliable, demand is steady, and they continue to produce cash year after year. In the top left is the speculative zone. These are smaller companies that are extremely hyped and trade at valuations far beyond their current revenue. They usually have modest or low market caps, but very pricey share prices because investors are banking on huge future gains. Examples include companies like Beyond Meat, Peloton, and AMC. During their hype periods, I personally avoid these types of bets as they're highly speculative and driven by momentum and online hype. In my view, it's closer to gambling. That leads us to this final one. I call it the overlooked zone. This is where I believe there is a huge amount of upside, especially in relation to AI. Let me clarify. The companies in the crowded zone are all staking everything on the idea that whoever spends the most money building the single best AI model will walk away with all the profits. But what if that's not how it plays out? A trend I'm noticing more and more among startups, small cap and mid cap companies, is that they're actually giving users the option to choose between different AI models inside their products. They let users select between Claude, ChatGPT, and Gemini, just to name a few. This matters because these models are now getting very close in capability. So the biggest driver of what users pick may end up being the price, which could drag these companies into a price war, which is fantastic for people using AI, but not so great for huge firms that have poured billions into developing these AI systems. It's a bit like petrol or gas if you're American. Imagine one station sells it for $1.50 per liter, and another offers slightly better quality fuel for $3 per liter. Sure, a few people will still pay extra for the premium option, but most people will opt for the cheaper fuel because it essentially does the same job. And that's the core idea. When new technology becomes good enough and interchangeable, the value doesn't stay with the companies that spent the most to build it. It shifts to the companies that apply it most intelligently. So that's exactly why I'm backing the underdogs. Small and mid-sized companies don't need to win the AI arms race. They just need to deploy AI on real-world problems at a lower cost without carrying mountains of debt. That's why I'm investing in a few small and mid-cap funds, as well as actively scouting for AI startups to back. So if you're a founder and you're searching for an experienced investor with a large social media audience, then feel free to get in touch using the email in the description. I'm currently reviewing opportunities. Look, if I'm wrong, I lose a small amount by being early. But if I'm right, I'm positioned where there could be enormous upside. I feel that many people don't realize that every major technological leap creates opportunity, but more importantly, instability. I mean, AI isn't just transforming businesses, it's reshaping power, currencies, and confidence in the system. That's why I'm increasing my gold holdings, and I'm not the only one. Take a look at this. This chart tracks China's gold reserves between 2009 and 2025. Up until 2023, they were gradually adding to their gold. But as you can see, in recent years, they've been buying more gold than ever before. But why does any of this matter for everyday investors like us? Well, many believe China is attempting to challenge the US dollar, as they're not just acquiring gold quietly, they're making it functional. They've been constructing something known as the Gold Corridor, which allows gold to be stored in multiple locations and used as a basis of trust in international trade, especially with Brazil, Russia, India, and South Africa, collectively known as the BRICS nations. And it isn't only China. Gold has now surpassed US treasuries as the largest foreign reserve asset held by central banks globally for the first time since 1996. So why are we witnessing this sharp move towards gold? Well, as of 2025, gold has been reclassified as a Basel III Tier 1 asset. In simple terms, gold can now be treated the same as cash or US treasuries on a bank's balance sheet, which is a significant shift because before this change, banks were not allowed to count its full value. This is having a major impact on gold prices because before this reclassification, most big institutions like central banks, sovereign wealth funds, and pension funds kept around 20% of their reserves in gold and similar hard assets. However, Bank of America has now published updated guidelines stating that gold reserves should be closer to 30%. That extra 10% is pushing up demand because you can't simply print more gold. Some people are even suggesting that in 5 years, gold could be worth twice what it is today, and I don't think that's completely unrealistic. I'm not going to go much deeper into gold in this video, but if you want me to unpack it in more detail in a later one, just hit the like button and let me know. If we hit, say, 150,000 likes, then I'll put that video together straight away. For now, let's move on to the part I know many of you really care about. How do you actually invest in gold? Personally, I do it in a couple of ways. First, I buy physical gold. This is my long-term insurance, and because I'm old school, I like owning something I can physically hold. Second, I dollar cost average into this iShares Physical Gold ETF on Trading 212. I like this because it gives me far more flexibility to steadily buy in and move money around when necessary. So to be clear, I'm not trying to time the perfect moment to buy, and I'm also not going all in on gold. I'm simply allocating a small, strategic slice of my portfolio to gold, in the same way that countries and major financial institutions are doing. The biggest error young people make when investing is not having a large enough cash cushion in case something happens in their life, which often forces them to sell their investments at the worst possible moment. Even as an older guy, this is still something I need to think about, particularly if we're in an AI bubble. And you might be interested to know that Warren Buffett, the most successful investor in history, is currently growing his cash pile. Take a look at this. As you can see, he's been rapidly building his cash position over the last few years, and as of Q1 2025, he holds an enormous $347.7 billion in cash and cash equivalents. This makes sense because he's a value investor and only buys when the price is right. And right now, he simply doesn't see many deals that justify putting that money to work. That's why I'll be keeping a bit more cash myself, because if the markets tumble, I don't want it to seriously disrupt my life. Holding some extra cash also puts you in a position to buy more investments when the market crashes. And I say when, not if, because it always happens sooner or later. I was also focused on sharpening my money-making skills during the dot-com crash in the early 2000s, and that turned out to be incredibly useful, as I was able to generate quick cash that I could then put into the stock market. On that note, I'm actually teaching you the fastest route to making $10,000 a month online without needing startup capital or prior business experience in a free live online event very soon. So if you're serious about raising your income, then make sure you sign up for that. I'll leave a link down in the description. This is extremely important because cash is king during a stock market crash. I've watched far too many people wait years for a market dip and miss out on huge gains along the way. That's why my approach is straightforward. I'm still going to keep directing most of my money into the S&P 500, so that if AI keeps driving growth, I'm invested in the companies leading that shift. But to shield myself from a possible AI bubble, I'm also spreading out into global markets, small and mid-cap stocks, gold, and cash. Because the reality is, no one truly knows what the market will do next. So instead of trying to predict it, I'm positioning myself for both scenarios. If you want to learn exactly how to invest as a beginner, step by step, then I'm going to leave that video right up there. But don't click it just yet. Make sure you subscribe if you want to grow your wealth. Alright? I'll see you over there.